Now entering the Bitcoin Podcast Network.
Ether is the perfect drug for Las Vegas. In this town, they love a drunk. Fresh meat.
Come on, buddy.
So they put us through the turnstiles and turned us loose inside.
Welcome to another exciting episode of Dose of Ether. Bijan is at the Crypto Invest Summit in our conference interview series, and we get to talk to entrepreneurs trying out new projects in the crypto space. First up is Abstract Tokenization, where they're automating the process of issuing security tokens specifically for the real estate sector. After that, it's Expert Dojo. Need to fund your business without an ICO? Look at traditional accelerator funding at Expert Dojo. Rootmont is offering metrics for institutional investors built on a principle of finding out how projects are built, how it's being used, how it's being traded, and the social media perception in measurable metrics. Next up is Marketing Maven, a reputation and legitimacy provider in the form of marketing. So, pay these people money in order to make your project actually look like it's worth something. Next up is Token IQ, another security token offering, but it's actually built off of the Stellar platform. And they explain why they decided not to use Ethereum. And as the previous security token offering, their first deals have been shown to be in real estate. Listen up.
I'm here with Abel from Abstract Tokenization. They have a product targeted to commercial real estate operations for tokenizing securities and assets. So let's get into it, Abel. I probably butchered that quick, 5-second summary, but tell our listeners what Abstract Tokenization does.
Well, thanks for having me, Bijan. I appreciate it.
No problem.
Excited to be here. Abstract Tokenization is a service platform for commercial real estate sponsors and investors that automates all the different pieces of a security token offering. So the legal, the technical, token structuring and smart contracts, the operational servicing, so the ongoing life cycle of the token. We're automating reporting, automating distribution processing, and making it super easy to manage your cap table.
Did you forget anything? Because that was like a dozen different services that you offer. I'm amazed that you can throw that off the top of your head. The question I have is, why do you need a full service provider? Why do you need end-to-end service provider? Because I see companies that are doing just this, the tokenization or just the legal side of it. How are you approaching this from a full service standpoint?
It's a great point. And for us, end-to-end is extremely important when you're addressing a target market of commercial real estate sponsors. They want a one-stop shop solution. They want it to be simple and easy and familiar. And for us, we want to be able to provide this full process that they can come to just one place and have it all handled, right? They don't have in-house tech
because
developers.
these are traditional real estate organizations,
and so the change is hard enough to sort of adapt to, and so we need to make it as palatable as possible. And what we do, our ecosystem, we have a marketplace. We're pulling in all the various providers from, digital asset custody, qualified SEC qualified custodians for digital asset custody and digital wallets. The compliance and regulatory structuring on the token side. Everyone on the real estate side, there's 20 plus folks that go into any commercial real estate deal, from lease auditors to inspectors to attorneys.
And are you the point person for all those intermediaries, those partners
right.
that you?
So we're basically the aggregator, bringing all these different providers that are necessary for a successful offering into one single place, and we're putting the process together. So it flows seamlessly for.
And that makes a lot of sense. And I assume there's probably white label or white glove services out there for traditional real estate transactions that would help in this way, but they wouldn't do the tokenization piece of it. So right. Tell her why would a commercial real estate operation, let's say it's an office space with 100 units, why would they want to tokenize their property?
That's the $1 million question. So number one, liquidity. Right now, in 2017, 280 trillion in global real estate assets. only 1.4 trillion of that 280 trillion was exchanged in 2017.
Yeah.
So less than 0.5% liquidity in the largest asset class in the world, number one. Number two is access. So right now, and let's just look at US commercial real estate sponsors. There's not much access to international investors, much less the 2 billion unbanked individuals around the world. So with this new structure from the Jobs Act and with blockchain technologies, now we're able to lower the investment minimum for international investors and open up this new pool of global capital for the sponsors to tap into, and then also opportunities for foreign investors as well as US to now invest in a piece of real estate at a lower minimum and without having to be locked up for 7 years, 9, 10 years, which is typical with institutional quality.
And
real estate.
is this where, let's say an international investor is this for people who want a piece of one of those properties, or to create a bundle of different regions that they find interesting? And what would their alternative be? Would they have to buy a whole property as an international investor, or could they get a piece or a 10% stake somehow traditionally?
It's a great question. So our initial vision for the company was to democratize land ownership for everyone.
Wow.
And the idea was that
really important for people like me in Santa Monica.
Right.
It's in the LA SF we have this huge problem of access to real estate, and the lock-in, the amount of inertia and momentum that people with wealth have on the rest of the world, right?
Right.
They're able to retain their place,
right?
right?
And why shouldn't anyone be able to own, whether it's a condo complex in LA, an industrial building in New York? We want to open up this ability to own land for the first time ever in history by anyone in the world, instead of just this.
And so let's get into, I think many of our listeners are probably familiar with tokenization of real estate. We've talked about with a couple other companies in the space. I guess how would an investor really benefit from this? If they were to get a really small share in a commercial real estate property in LA and they live in Kansas somewhere, how do they get some of that upside?
Sure. So number one is direct control. So you can specifically pick what you want. You're not getting put into 100 different properties diversified and paying a management fee by a REIT manager or a real estate mutual fund. So now you can literally specifically pick out each one by yourself and trade and transfer those much more easily. So number one, and then number two, you're able to get in at lower minimums. So you're able to actually diversify yourself by having access at these lower minimums and to sort of higher quality properties than you typically would have access to, since we're fractionalizing the ownership down. And the most important piece is the transferability without affecting the sponsor, or the issuer of the capital, right? So now there's peer-to-peer liquidity that's provided that doesn't affect the project. If it's a development project that needs capital to build, that capital is still there, and you're interchanging on a secondary that is now facilitated by a number of folks coming to, Open Finance Network, T0, even Binance, Bitrex, the typical exchanges are now buying ATSs and BDs.
Is there a feedback
space.
loop in here somewhere where, if you are working on a development project and you sell a 50% stake to finance it, let's say, as you go in, there's some incidental expenses and issues that rise that you need to now get more funding.
Right.
If in that time period, let's say that 3 years that you've been doing development, you've been building a secondary market for your project, building a community around that, is that an additional benefit so that when you do go back to the capital markets, now you have access to capital just organically, from users people who are already interested in your product and already buying it.
Exactly. So the issuer has the ability to sell some of their tokens, as well as the the other model we're looking at, which is more the traditional commercial real estate raise model. Is you have several phases. So you have a construction loan phase, you have a building phase, and then once the assets stabilize, there's different levels of risk tranches, and so you can have several different offerings with different characteristics to each one that are specifically geared towards the tranche or stage rather of development of the real estate. And then also there's the ability to, you have an existing asset, you want to recapitalize it, you want to convert it just to tokenized securities from a traditional security ownership structure. We can obviously accommodate that as well.
So that's very interesting, and I know, I've heard another company I was speaking with who was actually doing redemptions, and that's a part that I don't really clearly understand the benefit of, but aside from that, let's talk about the minimum really quick. What would a typical minimum, what would a typical minimum be in the traditional environment versus what the new
a
technology?
typical, in the traditional environment, it's 100,000 plus, right? Sometimes even more. In the new environment, it could be as low as $1,000 or even less if the sponsor, the issuing sponsor, it's up to them. So they can decide, okay, we're going to set it at this level. There's certain costs with each investor for KYC, AML, and so forth, but it's up to the sponsor. They can set it as low as $100 if they want.
And this is leveraging Jobs Act regulation where
That's
you've
right.
got like Reg A, Reg D,
That's
and
exactly
so
right.
up to a certain amount, right? Once it gets past a few $1 million or whatever, they.
So yeah, let me quickly speak to that.
Yeah.
So SEC registration exemptions, Regulation D, Rule 506C, basically allows for an unlimited amount of money to be raised from only accredited investors. Regulation S allows for an unlimited amount of money to be raised from accredited and non-accredited investors internationally only. And then Regulation A plus allows for up to $50 million to be raised from both accredited and non-accredited globally. So that includes non-accredited in the U.S., which is a new thing. Now, the only issue with Reg A plus right now is there's additional reporting requirements that can be a drag on performance. And so, there is some latitude, it seems like, that some of that will be updated by Congress, and we're hoping to see that because, for us, we think Reg A plus is ideal. And we'd like to go that route, as long as it's not cost prohibitive. Now, the one other thing I would say is we're going to be starting probably with the Reg S combined with the Reg D 506C. But as the environment matures, I think there's a huge opportunity. Now, the other piece that is important to keep in mind is there's something called 12G reporting requirements.
Yeah, I was going to ask about disclosure, because how does an investor on the secondary market actually know what the quality of the project is if it's a private project?
Well, exactly. And so we actually build in a lot of the property information into the token itself. We have, there's quarterly reporting, and so it's actually up to the sponsor what they report. And so essentially,
so the investor can make a decision based on how much transparency.
Basically, what they're reporting typically to their investors, and there will be a lot of information out there. It's the issuer puts out on the offering and maintains. Right, there's property value and reports and so forth that are communicated to all the investors. And the other important thing is, as we look at how do we get past the 2,000 investor limit to make a market, right? On the secondary, if only 2,000 people are trading, there's not much volume or market there. And so if you're working with transfer agents, you're now able to go up hundreds of thousands of investors on cap table without triggering 12G reporting requirements, because just the transfer agent is on the cap table, and so they're actually holding custody of all the shares. And so working with a qualified digital custodian along with the transfer agent, and I was just having a conversation with V-Stock Transfer, which is one of the second largest transfer agent in the world, and with the chairman and CEO of V-Stock Transfer, and they're aggressively moving into the digital transfer space, which is really good news for all these digital asset offerings and tokenized securities, because it essentially enables a large secondary market to grow. And I think that's a key piece that's been holding some stuff back. And now that Computershare also has expressed appetite to move into which is the largest transfer agent in the world, to move into the digital
and
asset transfer.
So how should we think about getting a typical commercial real estate property owner into this space? How long can they expect this process to take? What fees would be associated with it to get it done? And how do they get started?
Yeah, so for them the process is actually made more efficient. It's shorter because we're bringing all the pieces together. We've got all the different due diligence folks signing off in conjunction with each other. The fees are lowered as well because everything from the distributed ledger technology we're using to the automated reporting, automated distribution processing, so it lowers fees, especially on the maintenance and servicing side. On the upfront side, you're opening up a new capital pool, which creates more demand. And our fee, we're just charging a technical tokenization fee, and we're working with a network of distribution partners from broker dealers to folks internationally for the capital raise piece. And so, we're charging a very small piece of the total offering. And so, I think the most important thing is the benefit of a tokenized security and of getting the liquidity. Economists have quantified the cost of illiquidity at anywhere between 15 to 30% of the underlying asset value, right? But
that is only a problem for people who need liquidity, who are planning to get some liquidity in the next 5 years or so. And then secondarily, if they get in now, isn't it a problem that there aren't a bunch of offerings out there that investors on the secondary market can avail themselves of?
Yeah, so look, number one, there should be a liquidity premium that is realized as the underlying security token starts to trade. It should trade up a bit because there's an option for liquidity. Number two, I think it's a great point in terms of the secondary market. It's not just going to explode out of nowhere, right? We're just seeing the initial STOs coming out of like Reg 506C lockups 12 months ago. They were issued 12 months ago. Now about to be listed, right? Open Finance Network is about to be live, and the first ones are actually going to start trading. This is going to be a slow process, and it'll take years for the volume to start growing. And the key piece for the volume to grow is one, what we talked about earlier, expanding beyond just the 2,000 limit and not triggering reporting requirements. So now there's more of a market and more volume. But number two, institutional, bringing institutional capital in. So Fidelity Investments just launched their Fidelity Digital Asset Services, which is digital asset custody and trading services for their 13,000 institutional customers.
So, sir, let me break down the urgency for potential investors and property owners in this space. Is that if you don't act now, you're going to. If you do act now, for one, you're going to benefit from the institutional investors and other secondary market investors who do come in the early days and are looking for opportunities. They're going to be looking at a few opportunities, and yours might be one. Second, the costs with onboarding when the demand has now grown might put a strain on the market, and you're available now to start this process. And it might take years for it to. You don't want to start it when you need the money, right? When you need access to liquidity for your property, you need to do it years before because there's that lockup period and so on, right?
And bottom line is, if your competitor is doing it and offering liquidity after a year, and you're offering liquidity after 7 years, and it's the same, sort of property deal, investors are going to start going to the person offering the liquidity. It's as simple as that.
Yeah, and with Fidelity getting in the mix, and these other companies just making it super easy for investors to onboard into the tokenization revolution.
New York Stock Exchange's parent company, ICE, Intercontinental Exchange.
So it's coming. So we need to get ready. How do we find out more about abstract tokenization?
Yeah, you can visit us at abstract-sto.com. And reach out to us there.
Excellent. We look forward to buying all of your commercial real estate tokens.
All right, thanks.
See you. I'm here with Brian McMahon, and he is the founder of Expert Dojo, a blockchain beach-based accelerator for all sorts of startups. And what we'd like to talk about today is why has it been so hard to invest in blockchain companies?
Great to be here. Firstly, at Expert Dojo, we invest in lots of companies. We will invest in over 20 companies in the next 2 to 3 months for our next accelerator cohort that will come through. So we love early stage business, and we love businesses who are going through change. Second point that I will add is I believe that blockchain and crypto are two of the greatest innovations that have happened possibly in my lifetime. Right? I never expected money to be disrupted, so for me that's really cool. Third thing I will say is most of the investment opportunities over the last 3 years were a great big pile of shit. Yeah. So we didn't invest in them because they're valued at 4 times over what they're supposed to be, so that pump and dump investors can put money in, take the money out without any real regard for the entrepreneurs. And we believe in building real businesses with predictable outcomes.
And I would kind of point to the internet as an example of where the hype outweighed the value, and where we got buzzwords and technology driving the conversation over what products and businesses are you actually creating. And I think we suffered a lot from that, where a lot of companies in the space are leading with the fact that they're blockchain. They're adding it, public companies are adding it to their name and seeing 100% increases and subsequent SEC inquiries because of it. So
it is better this year, though.
And it seems like the ICO hype is gone because companies realize that in order to get access to U.S. capital investors, they need to be on board with the regulations that are around the U.S. customer base. And so I guess my question is, where do you see the blockchain companies ignoring that they need to be focusing on if they're going to succeed in this industry?
All those things are important. I think the attorneys got a tiny bit carried away and they saw a lot of money to be made and they jumped onto the whole, I'm going to do an ICO for a bullshit company extremely quickly, and that's okay. And now that's changing, right? The attorneys are starting to realize there are some repercussions for some of the decisions they made back then. But for me, it kind of goes way deeper than that. I mean, the regulation will work itself out, the attorneys will work themselves out, the companies, the tax, whether it's a utility token or a security token, all that stuff will work itself out. My problem 2 years ago was that the companies themselves were just not good companies. They just were not companies. And I always use the example, is this a company that I would say to my mom, you should put $50 into because you've got a reasonable to okay chance of getting a return. And when I look at the fundamentals of a company and I realize it's a flawed product in a non-defensible marketplace with a piss poor team of 12-year-olds who are building something that have got no experience in anything else other than having their diapers changed, then for me, I'm not convinced that company should be worth $400 million or $1 billion or five. Like, just to put it in, let me put it into perspective.
Sure.
Google, when they were going through pre-seed, were valued at $5 million. EOS, which has done fucking nothing, is valued at $5 billion at the start, right? So I'm sorry. Forgive me for being a tiny bit weird about the whole blockchain space. But look, here's where it's good right now. We're now seeing real companies coming through. A lot of the shitty companies have been washed out. A lot of the entrepreneurs who felt it was just a money train, which it was, or the attorneys or the marketing companies, are realizing now it's much more difficult. And a lot of real investors who always wanted to be in there in the first place, like us, are now looking to invest money in blockchain companies that are making a real difference in the world, or that can make a lot of money.
And the argument to date has been that, oh, these companies are focusing on layer one blockchain tech. You can't understand why it's valuable. Give it some time. We're working on scalability, security, and you've got now 100 or 1,000 different layer one blockchains that are trying to solve who knows what problem. But the argument has been we're solving technical infrastructure, and you shouldn't expect there to be applications that consumers, that your grandmother is going to understand or
like
use.
Google wasn't. Right?
Well,
No,
Google.
I'll make a point. So number one, the companies that we saw coming through in 2017, like one of the 80% of companies that are already dead, like blockchain companies have set new records in how fast a company can fail. And I'm talking like even in the internet bubble in 2001, it was hard to fail as fast as blockchain companies failed in 2017. Bullshit companies. And they weren't even level one infrastructural companies. We're talking about companies coming to me in our accelerator and saying, dude, I want to put a dating app on the blockchain. It's like, fuck off. You think I want to remember every date I've had for the last 20 years and put it on the blockchain? Like the opposite.
Right.
So actually I think we're moving to a place of infrastructure.
And what's exciting is that entrepreneurs have the courage to go out there and talk to accelerators with really half-baked ideas and half-baked teams and all this. What it tells me is that there is a massive number of entrepreneurs that are getting into this space. Yes, 90% of them are, on the face of it, dead on. Their companies are dead on arrival. That's fair, but we're separating the wheat from the chaff right now.
I think
right?
so.
And
better time.
And so, what are you looking at now? Are you looking at consumer products? Are you looking at big ideas? Are you looking at where is it going to generate revenue today? How are you thinking about this space?
I actually look at it the same way as I look at any other company. I go deeper than the team. I want to see the domain expertise of the team and what abilities they have to make it through the multi-levels of actually raising money and getting to a strong company.
Are you putting the product to the test in your mind, or are you actually going out there and talking to potential customers, looking at competitors and trying to understand, will they have a place in the market?
So the product is important, but we have to remember it's hypothetical at the start. So if we look at Messenger, when Messenger first came out, there were 1,000 competitors to Messenger, but why did one Messenger product make it through and the angels and the people who were involved in that get themselves to a place where they got huge returns? Because they focused on user experience. I believe user experience is going to be tremendously important in whatever application making it through. Like take exchanges within crypto right now. There's how many? 1,000, 2,000, 5,000 exchanges coming through? Like which exchange is going to come through and why? You could argue the exchange that has access to the most amount of money, even if they have a terrible product, even if they have a poor user experience, that money will help build them through. So look, we can't forget the access to money is going to be really important. We can't forget that the domain experience of the people is going to be tremendously important as well. And like, is it solving a real problem, or is it just something that's been put in because somebody
part
was
of the hard part is that there haven't been some of the really critical pieces that make the promise of blockchain really possible, like being able to, we don't even have to go into examples, but entrepreneurs in this space have a really hard time solving the usability problem because customers don't have cryptocurrencies. And if you want to get them on blockchain, if you want to take credit card or something else that they're familiar with, they have to still go through 35 steps and wait a week to get their crypto kitty.
For sure.
So, how can we rethink this from, we can wait. There's 25 million supposed cryptocurrency users today. We can wait for the next 100 million to slowly adopt at their own pace. But is there another way? What I've heard at security token conferences and blockchain hackathons is crypto native. We have to go after the crypto native users. I think that's the existing user base that is already not using CryptoKitties and these other products.
Yep.
But going after consumers, maybe it's too early. Maybe the tooling to get it in place, maybe we need those fiat onboarding systems to be seamless and the token swaps from one to another to be seamless before you'll get a successful consumer application. Further, what if we could find a way for customers to earn cryptocurrency so that they don't have to convert it from fiat?
Maybe. Look, all of these things are fine. The internet was early once, right? I mean, late 90s, early 2000s, it was late. And the people who are coming up with products on the internet, and look, we all know timing is everything. It may be that we have a great company, a great user experience, lots of money, but the timing is just wrong right now. It's a great talk by Bill Gross from Idea Labs on timing. And for me, it's more simple than that. Like, we're an accelerator, right? There are 5,000 other accelerators in the US. What makes us better than any other accelerator as far as an entrepreneur making a choice to come to our accelerator and us getting the best warrior in our view for that thing? It's personal brand. Your business brand ties into a personal brand. Personal brand is what's appealing to other people. People have always been attracted to people. That's why we just saw Tim Draper walk through, and he's got
an entire
posse of people. They don't even know what to say to him. They just want to be close to him so they can maybe touch him. And he's of no value to them, but his personal brand is strong enough that they want to get involved. So my advice to anybody in ICOs, anybody raising money, is build a fucking personal brand that makes you a value to people. Like, don't just go out because you got a nice white paper and you're going to travel to 40 countries and you're going to go to all these different places that you can do stuff. Like, go out there, build a brand, make it a strong brand, make it of value, and then people will listen. And by the way, if you don't have a brand, which most people don't because the product's not good enough and they don't really have something to say, then it's okay. Like, find something better.
Right. And what's the best way for people to get started with this? I know in my experience, I came from an industry that was not related to crypto at all. And I knew in order to build a company in this space, I needed to build some credibility. So I joined a podcast, and I was able to do that by putting myself in a position to get lucky, right? And what I find a lot of entrepreneurs in this space are doing is they're going up to, really influential, connected people, and they're saying, how can I get my company funded? Instead of thinking to themselves, how is this person going to be useful to my company?
Yeah.
How are they going to help me serve my customers? Who are my customers? I mean, a lot of them don't start with that focus, and they're putting the cart before the horse.
Yeah.
Do you think that is a lot of time spent filtering through these companies, or are you still giving them guidance even if they come to you and maybe they're not ready?
So look, we give everybody guidance. Is that guidance right or wrong? Who knows? It's our truth, right? But we give everybody guidance. Everybody should look for guidance. But I think we've just said the same thing. I'm saying build up your personal brand, make sure that you're a value to people, make sure that you have a level that when people are around you, they know that they're dealing with someone who's got a domain expertise or a value expertise in that particular space. It also does a secondary thing, because I say, like, find a problem that you need to get fixed. Yeah, you find a problem you need to get fixed, but it's hard to do that if you don't know shit about the space in the first place. So the only way you can find out about it in a non-arrogant way, as opposed to just sitting in your dorm room with 5 friends and say, hey man, there's like a problem with the blockchain. It's like, no, get involved, find the real problems, go deeper than level 1 problems, all the way down to, like, what do people need fixed in a way that's a huge why to them. And then once you do that, then just go out there, use the personal brand that you built, use everything you've got, and then go from there.
So let's talk about Expert Dojo. You're in the Santa Monica, Venice area of Los Angeles. How many companies do you currently?
We've got 20 companies in the portfolio.
And how does it work? How do they get involved? How do you help them?
They come in, we give $50,000 in cash as an investment at the beginning. We then help them find subsequent investment through investors who are all part of our network. We work with them on a slightly different level. Most accelerators teach entrepreneurs how to find investment. Like, that's their URL. We believe that model is slightly antiquated, and we believe in building warriors and entrepreneurs. So what does that mean? It means we focus on 4 core areas. We focus on mindset in an extremely strong way. We don't see any difference between starting a business and running a marathon. And we focus extremely strongly on growth hacking. We believe growth hacking is a central core of everything. You build your business at the beginning. Don't bullshit around looking for investors. Just fucking build something that's useful. We then make sure that within the entrepreneurs we have, we're helping them build their personal brand. We believe personal brand is the strongest currency of today, and nobody else is focusing on it. And then at the end, we work on communication, because you're going to have to communicate with multiple different parties for the brand and the mindset and everything else that you're doing. That's it. Get them ready, get them trained, have them working together, build a strong community of those people, which is slightly more than just free beer and pizza, and then just send them out to war.
And where can people find you and send you their stuff?
Expertdojo.com. We're on top of the mall in Santa Monica, the Santa Monica shopping mall. We've got a big unit over there, so they can always pop in. We'll always be around.
And do you take companies from outside of Los Angeles?
Yeah, so we brought in a bunch of South Korean companies there last week. We love Israel as a place. We're looking at possibly 2 companies from Israel that we're bringing through. Look, it's easier and we've also opened in Dallas. I forgot. Sorry, Dallas. But yeah, so look, we're just looking for great people and with the potential to be able to grow something phenomenal.
All right, let's check out Expert Dojo at expertdojo.com. Thanks, Brian McMahon, for being with us.
You got it. Cheers, buddy.
I'm here with Christopher Smith from Rootmont Research. Rootmont Research is a firm that is providing for institutional investors quantitative analysis around different token projects and how you can really be a better and more informed investor. And so, while there probably aren't too many institutional investors on this podcast, we'd like to share with you some of the ways that the more sophisticated investment firms with teams of people that are doing research, how they're actually looking into these projects, and some tips and tricks to improving your own success, I guess, in investing. If you're informed with the right knowledge, you're going to do much better. So, Christopher, let's talk high level. What does Rootmont Research do?
So basically what we do is we do deep quantitative analysis on cryptocurrencies. So we look at many data sources for every currency in our catalog. There's over 400 now. And we do a bunch of data science on it to derive important metrics, and then put this in a nice, beautiful report, kind of collate it and rank the currencies against each other in these different categories. And basically we think of ourselves as objective sensors like the sense of like a microphone or a camera. And so we just want to show people this is what's going on. You don't have to go collect the data yourself. You still have to make your own decision about what to do with it and what's important and what's not. But we go through the hard work of calculating all this stuff.
Yeah, and that's really cool. I think, like for example, Masari is trying to take a different approach to this problem, where they're looking at investors in cryptocurrencies need to be informed, so they start with the same premise.
Right.
But their solution is we're going to coordinate all of the people in the industry to self-disclose subjective attributes of their company, like where development money has, well, it's not subjective, but it's maybe not public knowledge.
Right.
To disclose that willingly so that their investors can be informed and they can stay out of the SEC's eyes.
Right.
And your approach is, rather than trying to figure out the subjective notions around what a company should be valued and whether it's right or wrong, you're looking at what are the actual metrics of their token.
Right.
What is their long-term outlook from a purely quantitative standpoint? So what are the different inputs that you're using for your world censor of ICO or token data.
Well, yeah. So just to clarify, I mean, all the coins in our catalog are already on secondary markets because otherwise it's a bit hard to get data on them.
Right. So Masari, where their focus is on the pre-launch kind of due diligence.
That's right. We're
You're
post-launch.
looking at post-launch. How do you value the company today?
Right, and we have dozens of metrics that we collect, and then we organize them into, we really feel like there's 4 layers to a cryptocurrency project, and one is how is that being built, and so that's looking at, most of these projects are open source, so you can go see what is the engineering team doing. Even if you don't know how to code, you can still use your brain and look at the conversations that are going on there, look at how active they are, and make a judgment call. Are they really building something? Are they working hard? Is this like a garage project? What's going on here?
And so just to break that down a little bit, we talked about pre-token companies and post-token companies, but there is a difference between the token and the business, right?
Absolutely.
Because you can have a token without any product whatsoever.
That's
and
right.
so you're recommending that people look at the GitHub, or that you'll do that for your customers, so but you'll see how active are they on GitHub, how big is their developer, if it's an open source project, how big is their developer network, and are you looking at the actual things of what they're contributing, if it has end user value or not?
Well, there's a certain the more it moves into the subjective realm, the harder it is to automate. So then,
So you're looking more at like lines of code
Yeah.
versus if that feature is good.
right, it'll be like lines of code, number of like issues or number of forks, how many stars are on it, and so it's it's really looking at engagement and like activity, right? It's from a high level view. It's we don't parse the code and like try to see if it runs or if it passes the test.
So and you're trying to do this in a way that you can standardize it across projects, right?
Exactly.
So these metrics, so that's one aspect. So let's talk through the other, the whole suite of.
So we say that the sort of the foundation is what's being built, and then there's another layer which is how is it being used. So the blockchains in general are public, and so you can actually see real world transactions and use that as a proxy for a number of users, and then you can start to look at how is that relating to the price movement, and that starts to tell you. Some people say that cryptocurrencies don't have fundamentals, and we disagree. We think that the real world usage is the fundamentals. It's basically the business behind the coin.
Right, and that's like where Fundstrat, Global Strategy Advisors, or whatever that company is, they had a metric that really just relied on looking at Bitcoin transactions and number of addresses, and they were able to predict with like 97% accuracy the movement of Bitcoin, but they also predicted it would hit 25,000 by the end of the year. So are you triangulating on a direction for a project when you're looking at these various sources and saying maybe not any one of them is useful on its own, but taken as a whole, we can kind of see the direction this project's moving?
Yeah, I think it's really about there's so many things that have to go right in order for a project to succeed, and it could be something that goes wrong when they can't do the marketing, or that they have engineering issues, or they can't get people to use it, So we really try to look at all these pieces and let people judge for themselves what is the right approach. But like we talk about Fundstrat, that 90-something% correlation, that's gone now for Bitcoin. Now, there's still really high correlations for other coins, and maybe you have to adjust the exponent to find the best fit and things like that. But we think that in the case of Bitcoin, it hit a maximum a daily transaction, and this was sort of an artificial bottleneck. But what it did is it caused the price to diverge from real-world usage. And that's a really interesting.
Wow. And you think that parity is broken forever with Bitcoin? Like, what makes that true then? But now that the 600,000 transaction limit or whatever per day is we're nowhere near that. Are we seeing the correlation get back to what it was?
It's come back somewhat, but there's also this aspect of people are using Bitcoin proper less and less, and I think there was a kind of disappointment in the market. There's exuberance, and then the fees were so super high, and a lot of the merchants dropped them, and so I think that somebody else is going to nail the UX and the scalability issues, and I don't think it's going to be Bitcoin.
Interesting. Wow.
And it's a little disappointing to me because I love Bitcoin. I started out researching Bitcoin and just became obsessed with it, and so but what really matters at the end of the day is that people are using it, right? And so that's like Metcalfe's law is this way of, and they call it a law, but it's a way of valuing networks, and you really value them by the number of edges, not according to the number of nodes in it. And so the number of edges increases quadratically with the number of users. So it's like if I have a telephone and then you have a telephone and that's the only telephones that exist, there's only one connection. But then we add someone else has a telephone, now there's 2 more connections. And then the 500th person, there's 500 new connections. Right.
And once you get to a critical mass, now your platform is actually valuable to each user.
Right.
Whereas until you hit that level, it's not valuable to anyone.
Yeah, there's definitely a kind of chicken and the egg thing. It's amazing that Bitcoin went from 0 to 1, right? And there's really, some people have said, oh, you shouldn't have sold or you shouldn't have spent it, but I think this is the wrong way to think about it. I mean, every transaction that you make with crypto, somebody's accepting it, and that person is somebody that's now more aware of it and is sort of like another user.
That's so we've got the team and their productivity on the code level, their GitHub and their interactions with their community.
Right.
We've got the actual users.
That's right.
Of the platform. What else is important?
Well, so we also look at how it's being traded, and so it's not just the price, it's not just the trading volume. We also look at a bunch of portfolio statistics. So this is stuff that fund managers they're really trying to hedge their risk, right? They don't care. It's not just about how much does it go up or down. It's the volatility and different ways of measuring that. So it's how lucky do you have to get to actually take advantage of those gains, and so we take a bunch of these things. Another really interesting thing to look into is this upside and downside capture ratios. So it's like when the market is moving in a certain direction, how much does the individual coin move? Does it go with it? Does it kind of stay behind? Does it jump ahead?
Oh, interesting.
Right, and then you can also take ratios of these things versus how well does it do in a bull market versus a bear market.
That's it, and you're constantly keeping this up to date. So when the personality of the project changes, your report for that project will change in line.
Absolutely, yeah, that's a good way to put it. Yeah, we should use that personality project. So yeah, and then speaking of personality, one of the last layer is how is it perceived in social media, and so that we take a bunch of social media metrics.
That's huge in particular for crypto because of how speculatively it's driven and how little the dearth of actual useful information there is about these projects, right?
It's true. That's part of that's the gap in the market that we're trying to fill with our service, because there's a lot of interesting, funny, just likable people on social media that are talking about this or that, and some people are giving good information and some people are just shilling. And
so do you actually use use sentiment analysis to understand who may be a shill and who may be an actual an informed contributor? How do you differentiate between fudsters, mooners, hodlers, shills, and
Right.
all of the other categories of people on Twitter?
It's a great question, and we don't, currently we have sort of our first approximation of, and we do intend to get sentiment analysis and do more machine learning things in that direction. But really, the way you would distinguish what we think is the most important thing is you can look at. We have social scores and then we have usage scores, and we can compare those, and we can say you can get an estimate of we have this. For example, we have this metric, we call it the hype metric, and it's derived from social media scores, social media activity, and then we divide it by the log of the market cap. So basically saying how much does the buzz exceed the actual trading, right? And of course the trading can exceed the actual usage, and the usage could actually be based on a project that's not being developed at all. So you have all these layers interact independently, and but they're all important.
And when you're designing these metrics, this is all very fascinating, so thanks for sharing. How do you know, because ultimately you can't improve what you don't measure, so measurement is important, but knowing what to measure is even potentially more important, right? So you have a hype metric, you have MACDs, you have Metcalfe's law, you got all of these great things,
Right.
90 MA, 30 300, 200. How am I going to use that if it's based on objective data, but it's just a derivative metric of something else? how do you know that you're actually signal on this metric and not just another kind of noise?
Well, there's, it's a kind of a subtle question because, I mean, what you said about like knowing which things to measure. I mean, this is the art in science, right? It's sort of like you could measure anything, but like you have to form a hypothesis, and so we really, for a certain clarity of mind and also legal purposes, we don't want to tell people what to buy. And we don't want to tell people which of these things is more important than the other one. We do provide an API for example, for traders to, if they have their own algorithms that they want to apply to it and they just want to use this as a data feed. Because, when it comes down to it, nobody really knows what the future holds. And, anybody who tells you otherwise is lying.
And I think what the way that I see this is that Rootmont research is creating like a level of abstraction from the raw data in a way that is not accessible to institutional investors and traders who would have to really process that, parse it, and understand it themselves, right? Maybe come up with their own metrics. Instead, they can use that still, but they can supplement it with researched, quantitative, and novel metrics that actually give you signals about how the project is moving without just these very ambiguous terms like how many users they have, how many telegrams people they have. Like if you can get a hype metric and compare that with, compare their social media presence with actual transaction volumes and come up with a score around that, that seems very, very helpful for a trader who's looking at hundreds of projects and needs to just get the high-level overview really quickly.
Absolutely, yeah. I mean, we say that you can think of us as an outsourced data science team, and so we're nerds about this stuff. We were doing this for ourselves, and we realized, hey, probably other people are interested in it too.
I'm interested. I don't have the money to afford your products, I'm sure, but you sell them as individual reports per token, and also as a membership, and targeted primarily to institutional investors. But anyone can go in there and grab a copy of one of the reports for your favorite token and learn more about whether you should sell, hold, or buy more, for that matter.
Yeah. Well, and I'll be happy to give you a trial.
Thanks so much.
We're very proud of our product.
Good chatting with you, Christopher. Thanks.
Thank you very much.
I'm here with Lindsay Carnett, the CEO and president of Marketing Maven. I was just chatting with her a little bit, and I'm really excited to share with you what Marketing Maven does and how marketing can help crypto companies. I mean, it sounds like a crazy idea, right? Marketing for a blockchain company? Crazy. So tell us, Lindsay, why would anyone be a customer of Marketing Maven?
I think the biggest thing is for reputation and for building credibility, because this industry takes a big beating from mainstream media, and it's important to explain to people why you're a legit company and why people should want to work with you.
So most of the companies, when I'm going online and I'm researching crypto, I see Facebook has banned crypto advertising, JP Morgan thinks Bitcoin is dead, ICOs are scamming everybody, crypto exchanges are exiting with people's money. But this is supposed to be the trustless environment where you don't have to trust anyone to get the job done. It's kind of an interesting problem. How do you communicate trust in an industry where trust is supposed to be implied, but it's actually never really there? Like, you end up trusting these centralized providers in the end anyway. So how do you come at this problem from a marketing angle?
Well, I think with any change, there's always fear associated. So if you think of just even the cannabis industry and laws being passed here and there, unfortunately, we are dealing with a lot of really big players like banks, huge financial institutions, and it's almost like supplements dealing with the pharma companies, because the pharma companies have so much money, they're trying to keep the wall really, really high, so then you can't break through. So in this sort of industry, it's important to get the word out there that what you're doing is credible, and explain all of the positive practices that you've put into place as a company.
And so are you advising startups that are in the blockchain space and are trying to get consumer adoption, or are you helping them message to investors?
Both.
Oh, okay.
Yeah, on both sides. So what we're doing in the investment community is dealing with large media like Bloomberg, Reuters, and having them explain what sort of technology exists in this space. For example, one of our clients, Crypto Exchange Ranks, has this ranking system that shows how hackable certain tokens are. So we're able to capitalize on certain news trends which are negative and then turn them into a positive.
Wow.
So if there was some sort of big breach, or something collapsed, or there's some big scandal that happened, we want to know about it, research why that happened, and then have a solution to have that not happen to your token.
And as a product targeted to people who are not cryptocurrency users, do you help blockchain startups figure out the right way to approach their messaging so that they don't have to teach their customers about blockchain and all this crazy technology? Like, I don't know what database software any company that I use is running. Blockchain is really just a database in a way. So why are all these companies leading with, we're the blockchain decentralized Web 3.0 distributed application revolution product for the future, and I can't figure out what the hell they're selling?
Yeah, I think people in this space, companies in this space are having a tough time with messaging because I think you have to simplify things. And what we do is look and scour the internet of listening to conversations and where there are certain terms being used, who's using those terms, and we separate these into different buckets. So one is in forums, one is in news, one is in social media, and another one is in blogs. So we're looking at who are key influencers, what are they saying, what are the sentiments associated with it, is it positive, negative, neutral, and that sort of intelligence can help a company develop their messaging to find what is their point of differentiation.
Right, so you can actually design the message and the collateral to be based on the terminology that the users are already engaging with, right?
Yep.
So if they refer to it as a hub instead of a node, then you might want to use that terminology with your customer base, because that's what they're already resonating and responding to.
Yeah, and that can be from web copy to social media content to pitch content
so
for press.
How many coins does it take to engage you for your services?
Well, it's on a per case basis.
So, but really, how does pricing work? Do I, as a business owner trying to get better marketing for my website copy, let's say, is it an hourly thing?
Yeah.
Is it a project based?
Yeah, we can
payment?
get paid on an hourly basis and on a project basis. So
and why aren't more crypto companies using marketing firms and marketing talent to really help bridge the gap between the customer and the product that they're offering?
I'm not really sure. It might be because a lot of people in this space are from the technology background, or a lot of people are from the finance background, and I'm not sure what the answer is. Or maybe they feel like, okay, well, there's a disconnect between marketing and the development side, and the marketers might not know how to explain it. But
yeah, and kind of, I'm seeing a lot of the same thing, that a lot of companies came out with really deeply technical products. They got amazing amounts of funding, and then when they released, like Augur, great product, they have almost no users. CryptoKitties now, they did great, but now they still almost have no users.
Yeah.
And this communication to the layman, the consumer, person who's never heard of blockchain, that seems like a critical piece that people are missing, and now the focus has to be on, right?
Yep.
When you've got $100 million and no customers, you're gonna...
That's a problem.
That's a problem, right? So getting a marketing firm to help hone your message, to figure out what's the right way to communicate to your customers so that they respond in the way that you're looking for, right?
Yeah, we're essentially translators. We can translate the really sophisticated
Nerd
technology
speak into layman speak.
Correct. Yeah, and we're doing that with a lot of different industries, and we've had a lot of success in really highly complicated industries, really turning that complicated messaging into layman's terms.
That's really great, Lindsay. So tell me, what is the range of services that you offer?
Sure, so we're focused on, we started 9 years ago doing just traditional media relations, so PR, meaning TV, radio, newspaper, magazine, and online. And this is really focused on what's newsworthy. So if you have something that's timely, local, quirky, hard news, we put together a pitch, we pitch it out to the media. There's no money exchange. It's purely editorial coverage, and that is great for building third-party credibility. We're also doing social media marketing, and this is on a variety of social platforms. This also includes customer service too, via social media, influencer marketing, and then creative services.
Awesome. So you'll do design, copy,
Yep.
end to end,
Yep.
and you have a team that helps do that.
Exactly. So
Excellent.
everybody's specialized in their certain area.
Very cool. Well, it's a much needed service. Definitely crypto companies, you need better marketing. That's just coming from a user. I can't use half of your products. I've tried them all. Trust me. It's really hard. Talk to Lindsay. She's going to help you out. Where can we find out more about Marketing Maven?
It's really easy, marketingmaven.com, and that's MAV like Victor, EN.com.
All right, marketingmaven.com. I look forward to seeing the vastly improved websites of these crypto companies, and they're really hard to understand products.
Me too.
Thanks so much, Lindsay.
Thanks for having me.
All right, I'm here with Mark Vange, CEO and founder of Token IQ, the company that's going to unseat any challengers like Polymath and other frenemies of the company. But really, I'd love to hear from the founder exactly what you guys do. So why don't you intro your product?
Absolutely, thank you. We focus on the tokenization of securities. Our goal is to make security tokens that are fully compliant and solve some of the key kind of disconnects between the crypto world and the securities world.
And so you don't do ICOs?
We don't do ICOs. We generally don't touch anything that could be thought of as a utility token. Our premise is we need to embrace the fact that a lot of these things are actually securities, and kind of recognize that actually is very liberating. Whenever people tell me that that there's no clarity around the rules and laws, I actually kind of scoff at that, because these things are securities, they're securities laws, and lots of people know how to use them and interpret them, and that's kind of what we power.
And furthermore, given that these are security laws in the U.S., and the U.S. has some of the biggest capital markets in the world, you would think companies that were interested in having a long-term sustainable business would want to be in the U.S. market.
Absolutely. Between the U.S. and Europe, we've done some research between, depending on how you count, between 60 and 87% of all of the investable capital in the world.
Wow.
So if you don't sell to investors in those markets, you're just selling yourself short.
And one thing that I learned recently at the Security Token Conference just last week is that there are a lot of opportunities for companies to raise with retail investors in the current with the current regulations as they are. Can you talk about Reg A, Reg D, how much this allows a retail investor or a company to fundraise from retail investors, what the differences are, and why we might go with those routes versus accredited investors?
Sure, absolutely. So I'll start with the fact that I'm not a lawyer, I'm a technologist. So check all this stuff with your lawyer before you pull the trigger on it. But fundamentally, there are there's kind of a path of ever-increasing opportunities that come along with ever-increasing costs of compliance. And so for any given company, depending on how much you're trying to raise and what stage of the business you're at, one may make sense over the other. Even for investments, though, that require qualification, right, there's kind of this disconnect in the sense that the amount of work involved in qualifying each investor is pretty high. We did some research and it suggests that for every investor, there's 4 hours of office work, there's 4 internal emails, 4 external emails, 3 phone calls, right? You're paying a lawyer $500 an hour to do all this stuff. So the minimum size check you can take is $50,000 or $100,000, right? There's a lot of qualified investors in the U.S., millions of them, doctors and lawyers and accountants and people who would be qualified under SEC, so they have in excess of $1 million in assets, excluding their primary home. They make more than $250,000 a year, but they still can't write a $100,000 check necessarily, right? So by kind of optimizing the process and by making it a lot easier for companies to issue these tokens and comply and do the vetting and so on, you can actually open yourself up to investment from a much larger pool of even qualified investors.
And so how much do you reduce the processing time for an investor to onboard into the cap table for a company?
Yeah, so a part of what we've done is we've completely recreated the process online. So all the forms, all of the disclosure stuff, all of the contract.
So it's fully self-service.
Fully self-service. So the issuer still needs to vet, but we even connect with kind of the information systems that banks and credit cards use to do things like income validation and job validation. So even when people assert that they're qualified, right, it's not enough from the SEC perspective if people just check the boxes. Issuers actually are responsible to vet this stuff, but to even help with that vetting process.
And so what is your differentiator to a startup like Polymath or an a traditional financial organization that might be coming into this space?
So those are two very different competitors. So from someone like Polymath, and I mean, I love the guys over there. Trevor and I know each other quite well. I mean, they're great guys. They're based on Ethereum. They're trying to build this ecosystem up on Ethereum, which, from my perspective, is actually the wrong place to be.
And we'll talk more about that. Yeah.
But we just focus on very simple, kind of one thing, which is securities. We issue them on Stellar because we don't think that securities require smart contracts. And then we bridge to Ethereum if a particular issuer does require cross-functionality with smart contracts.
Interesting.
But you don't need a smart contract to actually affect the transactions.
And so what about the organizations who maybe are not crypto native but have all of the customers and those relationships and maybe already relationships with the SEC and are licensed and all this stuff?
So for those guys, right, all they understand is the securities laws. And so we make these tokens look as much as possible like securities. In fact, for our own offering, what we're doing is we're issuing two parallel classes. One is on paper and one is in tokens, and you can move back and forth between them. So if you are, a pension fund, if you are an investor who by charter is restricted to certain types of investments, you can buy the paper and have the option in the future, once you get yourself together, to transition to tokens. Conversely, if you want to be cool, you want to buy tokens, but you still want the security blanket of being able to move back to paper, you can do that as well.
And are there any centralized systems in here that maintain ledgers and do anything? Like, could I, as a user, independently verify that I have ownership of these security tokens and independently transfer them without crazy overhead from centralized services? Or how does that part work?
So one of the key differentiators for us from all of our frenemies, as I like to call them, is, and this is kind of crypto purist, is that the company actually still owns management of the float of shares or the float of securities, right? So ultimately the company is responsible for what happens with their shares, and the company is the one that can manage it. So if I get hit by a bus tomorrow and my kids and my wife inherit my tokens, her or her representative can contact the company and say, hey, Mark was hit by a bus, here's the legal form from the court that says that his wife now owns those tokens, here's her wallet transfer them.
And is the benefit here that we're eliminating a lot of the intermediaries that would have to be in the chain of custody from transferring from one person to another?
Absolutely. We're eliminating all of the overhead, we're making the transactions much faster, and we're allowing for much smaller transactions, much more fungible transactions.
And where do you see the biggest asset class that's going to be impacted by security tokens?
Ultimately, I don't know what the biggest will be, but the first one is clearly real estate. Our first deal is a real estate deal, where the first kind of real STO announced was actually a real estate deal as well.
Is there an opportunity for homeowners to get some liquidity from their homes without refinancing through a security token offering?
I would argue it is a refinancing. It's just a matter of where you go to do that financing, right? So the first deal we're doing, it's a company called Oxygen Hospitality. They are a very cool high-tech operator and builder of hotels. So they want to be equally high-tech in the way that they raised and funded this thing. And if you look at it, it's a note, right? It's no different than a mortgage, if you will, but it's not to a bank. It's to a bunch of investors who loan the money and they pay them interest every month and all that stuff. And we transact all of that through Stellar, so no one's sending checks, no one's having to go cash anything at the bank, right? It's all happening smoothly, and it is no different than a mortgage, just different in size.
Very cool, very cool. And I think for real estate, I would 100% agree, because it's the biggest asset class in the world at $240 trillion, and it's also the least liquid. Maybe not literally, but in terms of, it's up there, right?
And I think it also is an interesting use case because, when you tokenize a high-tech company, which, let's say, in itself is very speculative, right? You kind of have that blowback that the company is speculative, the mechanism is speculative, there's just too much going on. Whereas real estate is well understood, it's a traditional business, everybody understands that this piece of land has inherent value, So you can be a little bit more flexible with how you deliver the tokenization or the securitization of it.
Yeah, and what fascinates me about security tokens is that they are more familiar. We don't have to sell cryptocurrency and blockchain and explain how that works to help people understand that they're going to get more liquidity, faster transfers, and less overhead, less fees with the security token model. So let's get into what I'm sure is the burning question on all of our listeners' minds right now is why Stellar? Why the hell would you pick Stellar over our baby Ethereum?
Okay. Look, Ethereum is a fantastic platform. Smart contracts can do a lot of great things, right? But they also increase the complexity, they increase the attack surface, right? It's easier to get stuff wrong, and the transaction rate is much lower. The total cost of doing a transaction is much higher. And even if you take apart, the actual cost of Ethereum and how much gas is involved, just fundamentally the cost of the energy required to do the transaction each time is much, much higher.
And do you not see, is it a timing issue, or do you not see it feasible that Ethereum developers will solve these scalability issues?
So,
and frankly, the usability and development tooling around it.
So look, fundamentally, it's always going to take more energy to perform an Ethereum transaction.
Why does the energy matter if relative to the traditional banking institutions, it takes maybe less energy? If you consider the number of intermediaries that you're kicking out of the process, aren't we saving energy?
But you're not asking me to compare Ethereum to traditional.
I'm just asking why is energy relevant to your service?
Because fundamentally, energy is cost. Right? If I can do it for less energy on Stellar, it will always fundamentally be cheaper.
So if Ethereum is cheaper in the future, will you switch?
Sure. If someone can produce some version of Ethereum that can do hundreds of thousands or millions of transactions per second and not have a huge overhead associated with it, absolutely.
And so the thing I would push back on is the attack surface thing. Now I would agree developing smart contracts, especially if you want to formally verify, audit the code, very, very challenging stuff to do. With a simpler programming language and system maybe perhaps like Stellar, that might be easier. What I think would be more risky is the attack surface of the layer 1 blockchain itself. Because if Stellar holds, let's say, 90% of the tokens, and I don't know exactly what their token distribution is, but presumably it's not as quote-unquote decentralized or distributed as a platform like Ethereum. And so in the future, if they don't get, let's say, deep network effects, a 51% attack might be possible. Or if Stellar's funds are stolen, then somebody could attack your distributed, your DApp, right?
Okay, so I don't at all claim to be like the expert on the lower kind of functioning of either Ethereum or Stellar. Stellar is a very different kind of network. So it does, it has no mining, it has no 51% attack per se, right? It's quite a different mechanism. And so I don't...
You're right, yeah. Because it doesn't have an open set of nodes that can operate on it, it's really just the question of will the Stellar Foundation, who owns most of the tokens, always be a benevolent dictator?
Well, again, there's more and more kind of participant nodes that are not owned by the foundation, but I don't really perceive that as let's say, a fundamental risk either in Ethereum or in Stellar. If it's a very narrowly adopted chain or ledger, of course that becomes much more of an issue. I'm not really comparing them on that level. For me, it's just a matter of the frequency and volume of transactions.
Being able to get the job done. And because in Ethereum, I would agree, if you guys are trying to scale a security token offering, you've got billions of shares for a single product, you're going to have a lot of issues with the scalability with Ethereum today. So that makes a lot of sense.
And I should mention, for some issuers that we're talking to that do require a smart contract, you do bridge across to Ethereum and actually execute that stuff on Ethereum.
I gotcha. Okay, cool. That's good to know. So where can we learn more about Token IQ, our listeners, and what are you guys looking for?
So you can find us at tokeniq.io. So that's really simple. We are definitely looking for folks who are interested in issuing tokens. Folks who are fundraising, who perhaps are looking at more traditional fundraisers.
What stage fundraising do you think is most applicable? Are you looking for companies that have been rejected from Sandhill Road VCs, or are you looking for people that are in emerging markets that are trying to sell security token?
So the reality is, if you're trying to raise $100,000 or $200,000 and it's your seed round, you better off going to grandma and asking her if she'll write you a check, because the overhead associated with any kind of fundraising is too high for you, right? If you already have a little bit of money in the bank and you can now, afford to actually undertake a real fundraising round. So maybe you've raised $1 million and now you're going for $5 million. That's really the sweet spot for starting to think about Reg D, or if you're going to 10 million, 15 million, Reg A.
Awesome. Thanks so much, Mark, for joining us. And that was Token IQ, tokeniq.io. Check them out. Thanks for joining us on this weekly dose of Ether. We'd like to thank the Bitcoin Podcast Network for hosting this. Sorry if there were a few audio issues through the Crypto Invest Summit recordings that we did. We're going to improve this over time. Thanks for bearing with us, but we hope you enjoyed or took out from it some learnings and what you could. And we look forward to our regular schedule of Dose of Ether for next week.